Good afternoon, everybody. Welcome to our September power break. We'll get underway here in about 1 minute. I'm just letting other people in. I have turned off your microphones. I have turned off your videos just for your privacy and protection. Again, please use the chat feature to submit any comments or questions. As usual, we'll start off the power break with your questions. So if you have anything on your mind, something you've read about, heard about, your friends have talked about, you've seen on social media, anything that you'd like to talk about first, please throw those in the chat while we have a couple minutes as our late signer-uppers get admitted to the Zoom. So take some time to do that. If one of you could actually just send me any message to make sure this is working, that'd be awesome. Always like to check my technology before we get too far, because I may be talking to no one for all I know. That's one of the disadvantages of doing this on a Zoom format instead of in the office like we did yesterday. All right, I've got confirmation that we are working. Thank you, Roxanne. All right, it being 4 o'clock, I guess we will get underway. I have not received any chat so far in terms of questions, in terms of what's on your mind. So I'm going to give you a couple more minutes. Yesterday, during the two power breaks we had a lot of things on people's minds. So I know you're not just sitting around the house going, "There's nothing going on in the world that I don't have any questions about." So please don't be shy. I won't name you. If you just throw a question out there, we will focus on that topic for a few minutes for you. Again, I always use the threat. If you don't come up with something, I will go to my prepared presentation. So if that isn't motivation enough for you. That was not motivational enough to do anything. So we are going to move on. Feel free. Again, if during the prepared remarks you have something that comes up or it puts something on your mind, then let's talk about it. All right, so I'm going to be sharing my screen here. First thing we're going to talk about is the economy. And the big thing in the economy is jobs. Jobs. So last Friday's jobs report, but there was a report before last Friday's job report called the JOLTS report, one of my favorite ones, Job Openings and Labor Turnover Summary. And that gave us pretty hard data on July. So it's a little older, but it's a little more accurate. As you likely saw, kind of erased 911,000 jobs off the last 12 months that were created when BLS updated their methodologies earlier this week. So, the month to month can be a little inaccurate because of the resources they use. This one tends to be more accurate. So JOLTS reported in July there were 7.2 million job openings in the United States. And coincidentally, there were also 7.2 million unemployed individuals in the United States. Now, that one-to-one ratio, it has been a while since we have been at one-to-one. Previously, we had far more openings than we had jobs. Now, keep in mind that can be resolved two ways, right? There are only two ways to resolve that. Number one, you hire someone and that job is no longer open. Or number two, you say, we really don't need that person, and you take the job opening away. I can't delineate from the data, what percentage are being filled versus how many are being erased, but certainly job openings have come down. In the month of July, the BLS reports that we have 5.3 million hirings and 5.3 million separations. That's not growth by any stretch of the imagination. That is rather stagnant. Uh, since July of 2024, the greatest decline in job openings. So where have we seen, hey, employers are no longer seeking people? Number one is mining and logging, down 48% over the last 12 months. I cannot explain that one. Do not know what's going there unless they had way more openings, but down significantly. Private education down 23%. Durable goods manufacturing down 23%. So those job openings have diminished. In demand, well, our usual suspects. Greatest increases in information, technology, AI. It's up 76%. So if you're looking for something to come out of retirement for, there's a good job opening for you. Construction and transportation slash warehousing slash distribution, think Amazon, if you will, up 28%. So that's where the job openings are right now. Here is where they aren't. All right, just checking to see if anybody, we have a question on the Social Security tax credit. We will get to that, I promise. That is in the second half of our power break where we're going to talk about tax provisions that take effect this year and next year. So I will ask for your patience on that one. So on Friday, we got another job report, and that one hit headlines because that one was, how shall we call it? Disappointing. When we only have 22,000 jobs created over the course of a month, that is not keeping pace with what we need. Uh, so when we look at the employment situation report, which was a report on Friday, they showed that there were 7.4 million unemployed people. That is up. Matter of fact, the unemployment rate bumped up from 4.1 to 4.3%. Well, certainly directionally, that is not favorable. But if we look in historical context, is that a tragic unemployment rate? It is not. 4.3 is pretty standard fare. Matter of fact, by some standards, it's high. You go back to when we had peak demand early in the 2000s, it was down in the threes, but we're currently at 4.3%. What's a little more disconcerting is that the number of long-term unemployed, so these are people who have been unemployed for 27 or more weeks, that number has grown by 385,000 people over the last 12 months and now accounts for over 25% of the unemployed. So 25% of those 7.4 million unemployed people have been unemployed for more than half a year. So that tells you a couple things. Number one, there is probably a skill mismatch between those who are unemployed and those job openings that we see there. Or two, employers are just slowing down. And I've heard this anecdotally about individuals who are getting interviewed, but they go back 5 times and then say we've kind of put it on hold. So employers are showing some hesitation. Obviously, that's starting to show up in the unemployment rate. Obviously, it is a concern for the Fed as they meet. We'll get into a little more on that in a second. If we look at specific unemployment by education, right? So if we look at age 25 and older by educational attainment, if you have less than a high school degree, you did not graduate from high school, your unemployment rate is 6.7%. I like to turn that around and say, well, shucks, that means 93% of individuals who want a job, who did not graduate from high school, still have a job. That's actually higher than I would have imagined if you phrase it that way. If you bump to graduated from high school but did not go to any college whatsoever, unemployment rate is 4.3, so that's the average. Some college or associate's degree, unemployment rate is 3.2. And if you have a bachelor's degree or higher, 2.7% is your unemployment rate. So you can see, education still does pay off, depending on the position you are seeking. All right, moving along to inflation. So the Fed has a dual mandate, right? We are supposed to seek full employment, not defined, and full economic opportunity or potential, reach economic potential, keep inflation in check. Two competing mandates. To this point, they've been on hold since last December, saying those are equally balanced. We don't see either one causing more of a problem than another. Inflation has continued to kind of stabilize and waffle. Unemployment has kind of stabilized, ticked up lately, but stabilized. When the BLS releases the August CPI numbers, which it will do on Friday, economists expect year-over-year inflation to increase from 2.7 to 2.9. So for those of you who follow the Fed at all, you know their target inflation rate is dos, 2. It is moving away from their target. So how can they be talking about cutting interest rates when inflation is not near their target and is actually heading the wrong way? Well, a couple things in play there. Number one, they're more worried about jobs. They do not want the economy to stumble into, stagnation or, heaven forbid, a recession of some sort. And when consumers don't have money, don't have jobs, they don't spend money. That's a problem. On the inflation front, it's hard to discern how much of that increase is going to be because directly impact from tariffs, where things are costing more, and which keep in mind, the Fed has no control over tariffs whatsoever. If they happen, they happen. It's not an economic phenomena, it's a legislative phenomena, or in this case, an executive order phenomena. Uh, so if they were worried that there was too much money flowing through the system, that you had increased number of dollars chasing a limited number of goods, a la COVID, shall we say, then you would see them far more concerned and hesitant to raise rates or cut rates because you don't want to stimulate more growth. That's the last thing you need with inflation going up. So as the Fed tries to balance those two, uh, what we've heard from them over the last month in their speeches is that they are becoming more concerned about the employment picture. And particularly with two dissenting members at the last meeting, probably highly likely that we are going to see a rate cut on September 17th. All right. I'm just going to check to see if anybody has sent me anything else. Nope. All right. Then, just a note that you may want to be aware of. On September 30th, the federal government concludes its current fiscal year. By law, at that point, Congress is supposed to have passed 12 appropriations bills and have them signed by the president so that we can have a seamless entry to the new fiscal year on October 1st. It has been a daggone long time. I can't even remember. It's been over 30 years since they have actually met that deadline. So, as much as they are lawmakers, they are also law breakers, shall we say. They not getting it done, which means that we are more than likely going to see one of those continuing resolutions that is going to fund the government temporarily until they can get the process wrapped up. How far along are they, do you ask? Well, not very far. The U.S. House of Representatives has passed one of the 12 appropriations bills. The Senate has passed 0. In fact, if we take it a step further and look at the committee level, the House Appropriations Committee has approved 4 additional bills, so those are ready for House consideration whenever they get around to it. And the Senate has gotten 6 done, so halfway there. Yay! With just under 3 weeks, call it 3 weeks exactly, to finish things off. It's not going to happen. So now the games begin. They've already started to politically posture. The Republicans are calling it the Schumer shutdown already to kind of deflect the blame. No, keep in mind they are in the majority. If they could get a majority of their caucus on one page, they could fund a continuing resolution. But the calling it extortion makes it sound so nefarious. But the negotiating has begun for what is it going to take? Because there are a number of members on the Republican side that are like, we're spending too much anyways. There's no way we're going to continue on the current path. And then there are others that say, look, we got to keep the government open and functioning. Who wins? I don't know. Tough to say. However, we do know that markets have acted somewhat negatively when this confrontation occurs. The headlines become somewhat negative in terms of, oh, they're shutting down the government and you won't be able to do this and you won't be able to do that. We have to take a wait and see approach. One thing that they do not have to worry about is they don't have to worry about hitting a debt limit because thankfully they raised that in July, so we can be pretty much as far into debt for the foreseeable future that we need to be. And I say that thankfully very sarcastically. All right. That's what my prepared comments for the economy with a little peek at Washington there too. Is there anything else economically on your minds? Well, I feel time for you to type those very intriguing messages to me. One of the persistent themes that came up yesterday during our power breaks was France, and what is going on there and the struggles they are facing from a budgetary standpoint. Had a lot of questions about, how big a deficit are they running? What is their debt? How do they compare to us? So again, while I'm stalling so you can type more, hint, hint, just comparing where France is to where we are. Keep in mind, France has a little different mandate than we do. So as part of the European Union, they're supposed to cap their budget deficit at 60% of their gross domestic product, so the size of their economy. So it's supposed to be capped at 60%. They're currently running at about 114%. And that's a problem. So that's why they are talking about cutting this and reducing that and increasing taxes on this, all to try and get that back under control. Now, to put that in perspective, so France is at 114% of GDP. The United States, including all debt, is 124, 125. So we are, you would look at it using that statistic, in far worse shape than France. But then you say, well, what about on an annual basis? How much are they spending that they don't have? How quickly are they adding to that debt? And France is running a annual deficit of about 5.8%. So annually, they're adding to their debt at 5.8%. In the US, we're worse. We're over 6. We're over 6% budget deficits, and they're projected to get worse every year from this point forward. So if you look at what's going on in France, where they have a little external pressure to bring things down, it's causing quite the tumult, I guess would be an understatement. Here in the US, we don't have that 60% limit. We really are only limited by A, what the debt limit is, which they just raised, and B, by what our elected representatives think is in our best interest as a country. So far, they think it is in our best interest to, pile on the debt. What France is encountering is their debt interest payments are starting to consume a larger and larger and larger and larger part of their annual budget. We're experiencing the same thing, not quite to the same degree yet, but France is really getting hit by interest requirements on that debt. Naturally, bondholders like to get paid interest, otherwise your bond rating goes down, and then they charge you a lot more interest because they can no longer trust you. So need to maintain a worthwhile credit rating while servicing the debt and keeping your population happy. Happy is not what France is right now, as you can tell by the prime minister rotation and the general overall angry sights in France. The other thing to keep in mind is that France has a very slowly growing economy, and this is where we have a key competitive advantage. Our economy on a relative basis, again, some would say it's not living up to its potential right now, but on a relative basis, our economy is growing quicker. So theoretically, we can support a higher debt load than France. All right, I see that you have come up with absolutely nothing to send to me, which means you are really excited to move on to the market discussion for the month. We're going to start with our market stats. What happened. Oh, I got to rotate this for you. There you go. What happened in August? Clear winner. Clear winner for August. Winner, winner, chicken dinner is small caps up 7.1% in 1 month in August. What, you ask, may motivate someone to be very or more interested in small cap stocks? Well, if you are a small company, you tend to have more debt on the books. A lot of that debt is typically floating rate. So when rumors start to abound that the Federal Reserve may cut rates not once, not twice, but possibly 3 times before the end of the year, that is very good for you because your survival rate or your odds of success have suddenly gone up because you are not going to be paying as much on your debt service. So that has definitely had an impact on small caps in August. Everything else, kind of okay. It is interesting that international stocks doubled up the S&P 500 in August. So they have been on a tear this year. Much of that due to currency fluctuation. The dollar is down 12% so far through July and has kind of stabilized at down 12%. That really boosts international returns because when you bring those dollars back home, you get more dollars, which works out very well for you. So, uh, for example, international stocks year to date roughly double the S&P 500. It's been a long time since I've been able to say that. If we look at 6 months, probably a surprising winner here. Emerging market stocks? China? Vietnam? Indonesia? Yes. Those are the winners over 6 months and 12 months. Again, those are for pretty aggressive investors. They're pretty high volatility, but over the last 12 months, that has paid off. In the blue, these are average annual returns. Couple things to point out here. Number one, I'm going to look at 10-year returns for core bonds at 1.8%. That is nothing to write home about, folks. Just not much. But keep in mind, 10 years ago, the 10-year Treasury was around 2%, which means we got our expected return in that asset class. If we look at it on a going forward basis, which is really what counts, you can't backdate checks and invest them, 10 years ago. But going forward, 10-year right now is just hovering over 4%. So we anticipate, 10 years from now, when we get together for our September 2035 power break, that number is going to be closer to 4 in general. The other thing that is not sustainable here is this number. This is US large cap stocks. That is very unlikely to repeat itself as having a 14.6% annualized return over the next 10 years. That is very, very difficult to sustain. I'm not saying it's impossible, mind you, but the odds are stacked against it on a historical basis. All right, that's about all I wanted to touch on there before bumping down to our style boxes. Again, this is kind of just taking a microscope to US stocks and saying, all right, what's been in vogue? Value stocks, dividend paying stocks, old technology, as I call it, growth stocks, new technology, AI, biotech, all the exciting things in the world, and then different sizes of companies, the really big ones or the really small ones that are only worth like $10 billion. Yeah, small ones, $10 billion. Over the last 3 months, there is a definite theme here, and you can see it is all along the bottom tier where those small cap stocks have done quite well as the Fed positions itself for cutting rates further. Over the last 12 months, the theme is growth, undoubtedly, right? We have seen tech companies bounce back. We are seeing investment in infrastructure for AI. We are seeing the Metas of the world and the Googles who didn't have to get broken up last week. So that was good news for them. The Metas, the Googles, the Microsofts of the world leading the charge there. Again, this is in no way predictive. This is purely looking in the rearview mirror and saying what has happened. Next up, we're going to turn that into picture form in the form of our market mood meter and a definite trend here, right? You can see what's going on. Since July 2nd, our market mood meter has been stuck at upbeat or confident. There's not enough good news to push us to euphoria. There isn't enough bad news to push us back down toward hopeful or resigned. Um, you can see we definitely had a little bit of what I'm calling a tariff tantrum right here, where we got the opportunity to purchase long-term assets at temporarily reduced prices. At this point, I got to tell you, I'm not real enthused about where the market is. If you look at price to earnings ratios over the next 12 months, you would say it is expensive. If you look at, what could drive it higher, you'd have to say the Fed rate cuts are already built in. Not a lot of good news there. We're in a pretty weak time of the year. If you read the blog today, you kind of know that. One thing that is positive from a market standpoint is earnings have held up. Earnings continue to grow. That has surprised a lot of people that we've overcome tariffs and we've overcome some structural changes and some uncertainty, and companies are still able to make money. Earnings growth has exceeded expectations. But we will need something, either good news or bad news, to move us off of this upbeat / confident rut that we are in. I'm going to move from the stock markets to the bond markets, which quite honestly have been more interesting over the last 3 months. Uh, I'm going to bring up our yield curves. So just a reminder of what this is showing us. Over across the bottom here, we have different terms. So you can buy US Treasuries that mature in 3 months or 2 years or 10 years or 30 years. So this is their maturity. And up the left side here is how much interest you get per year for investing in those different maturities. Now, again, a normal yield curve would have very short-term rates, quite low, and longer-term rates higher, for the simple fact that if you lock something up for 30 years, you should get paid more than if you only lock it up for 3 months, right? Where's the commitment in a 3 month? Alas, looking at the green line, which was 12 months ago, we find that we had an inverted yield curve. The inverted yield curve that predicts recessions, except it's been predicting a recession for almost 3 years now and it hasn't happened. Um, so you can see a year ago we had a 3 month treasury paying, call it 5.25, and we had a 30-year bond paying 4%. That's weird. So, what the markets would really like to have happen is that this resolves to normal, where we are paying less on the short term in interest and more in the long term. And the ideal way to do that is to drag this green line all the way down here to like 3 or 2 3/4, something in that. Just drag that right down, and then everything would look good. Except you can tell from the blue line, ideal did not happen, right? The good news is we are less inverted than we have been in a long time. The bad news is that, while we did bring down short-term interest rates, and reflects the three Fed rate cuts from last fall. So they did bring down short-term rates by 0.75%. That moved the needle, just like they expected it would. But what happened on the other end is not what was supposed to happen. Instead of falling or staying stationary, long-term rates went up. Uh, that's not favorable. A, for people who like take out mortgages or have long-term debt, and B, for the government who has to pay now more interest on those bonds as they issue them. Couple reasons, couple theories for why this went the wrong way. Again, the markets will tell you it's the right way, but not the optimal way, I guess would be the way to phrase it. Number one, uh, economically, your greatest danger when you invest in a 30-year instrument where you put in hypothetically $10,000 and then 30 years later you get $10,000, one of your greatest enemies is inflation, right? Because that $10,000 you invest today is not going to buy the same amount of stuff in 30 years. So, inflation expectations, as the Fed has said, we're cutting rates while inflation is going up. Inflation expectations have bumped up. Therefore, bond investors want to be compensated for that risk, and they have required additional interest to compensate that risk. The other risk that I suspect we are on the front end of seeing is that we may not be quite as creditworthy as we used to be as a government. Once you cross that 37 trillion mark, or you're at 124% of GDP, or you have 6% budget deficits every year and projected to rise, and there's no solution being proposed whatsoever. If you're a bond trader going, I'm going to trust these guys for 30 years? I'm going to need to be paid a little more because things are not looking good. So I think you're starting to see that they are requiring additional compensation for credit risk on the U.S. government. Again, with the Fed set to likely cut rates again on the 17th, so next week, this has already come down. Current rates are up here and they have come down. Expectations are that, well, there's 100%. According to bond traders, there's a 100% chance that the Fed is going to cut rates next week. There's never a 100% chance of anything. But I will tell you, if the Fed does not cut rates next week, Katie bar the door. That is that's a quick way to get the market out of confident and upbeat into something much more dour. Because they have built it in at this point. All right, I'm not seeing any additional chats or questions, so I'm going to move back to my front page. And I got to rotate you again. Don't get dizzy on me here. There we go. We've already talked about this, 100% sure. Now, again, bond traders have been 100% sure before and been wrong, but that was further out. A week out, they're not going to be wrong. The Fed knows what the market is expecting. The Fed will meet market expectations. They don't want a tantrum. In fact, they're even giving a 10% chance of a 50 basis point or half a percent rate cut. That is not likely to happen. As we look out to the next Fed meetings, October 29th and December 10th, right now there's a clear majority. So not 100%, but say 88% and 66% of bond traders expect a rate cut at each of those meetings. That is far more conjecture than certainty. 917 should be a certainty. Then a note on the Magnificent Seven. Again, remember who those Magnificent Seven are? That's the tech companies that are leading the charge in AI, that have just basically driven the market over the last, call it 18 months to 2 years. So through September 7th, Magnificent Seven company with the highest year-to-date return is ranked 67th out of the 500 stocks in the S&P 500. So there are 66 companies that are not Magnificent Seven that had better returns than the best Magnificent Seven stock. There's even one stock that is number 444. Has to do with a company founder that found himself in politics. You probably know what I'm talking about. In 2024, so looking back to last year, four of the Magnificent Seven ranked higher than 67. So what we're seeing a gradual broadening of the markets, which is not a bad thing when you have more stocks participating instead of having this like pyramid of a few stocks, you get a broader base. That's a positive. Maybe I could put that in my reasons to be optimistic about the markets. And we've already talked about the US dollar. I'm not going to add to that at all. All right, I am going to take a drink of water. That will give you time to throw any additional, well, I guess it would be first thoughts, quite frankly, that you have economically or market-wise. And then we are going to flip over to our topic for our special topic for today, which is the tax bill that passed in July. So give me a second, I'll give you a second, and we'll be back. All right, a quiet bunch today. That's all right. Or you're all bots and I'm just doing this for no one. One or the other. We'll decide that later. So our tax bill that was passed is called One Big Beautiful Bill Act. That is the most moronic, stupidest bill name I have ever heard. I'm going to be quite blunt there. Sorry if I offended anyone or if you were going to name your child this, but this is not good legislation from a title standpoint. Now, as we go through this, there are a couple things to remember. Number one, if you would like a copy of this, you can email me. Actually, I will put it in the chat. I will put my email address there so you can email me and I will send you a copy of it because I am going to go through it. It is somewhat detailed and you may want to peruse it yourself afterwards. There, it's in the chat. I'm just luring you all there. That's what's going on there. If I have highlighted something in green, it's actually for this year. Yeah, they made stuff retroactive back to January 1st of 2025, so you get to do it this year. If it is purple, you gotta wait. So green is go, purple is you gotta wait. Gotta wait till next year. It doesn't start till 2026. If it is highlighted in yellow, it has to do with the time frame. How long does it last? And if something is highlighted in blue, it's a hoop. So blue is hoops. You got to qualify. You got to have a certain level of income. You got to start to do something. The government, you got to do whatever the government tells you in order to qualify for it. So we got green is go. We've got purple is wait till next year. Yellow is the time frames, and blue is the hoops. Here we go. The first thing we're going to focus on is tax brackets. So that was the uncertainty in planning over the last 12 to 18 months is would these tax rates remain in effect starting in 2026? And we now have our answer. The answer is yes. So that just all carries over. Note that in this particular document, I highlighted in yellow because these are now what they call permanent. I really don't believe in permanent legislation. So I would say indefinite would be a better definition. All it takes is a different Congress and a different president, and the rules change again. So, but the good news is those tax rates remain in effect for 2026 and beyond. The other little bonus they're going to give you next year is the lower brackets, so 10, 12, and 22. Let's say inflation is 3% for adjusting the tax brackets. They're going to do 6. You get a doubler. So expanding those brackets out so more of your income is taxed at 10, 12, or 22, depending on where you fall. So that's coming in 2026. Probably the most impactful, quite honestly, of the legislation is right there. The next thing they did for 2025, this is in green, right? So when we started the year, we were all assuming that you had a $15,000 standard deduction if you were single, $30,000 if you were married filing jointly. This actually retroactively to January 1st says, no, 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 it's not what you thought. We're actually going to bump those up already this year. So the 15 went to 15,750 and the 30 went to 31,500. So out of this bill, you have already won an additional $1,500 tax deduction for 2025. Congratulations on that. I am not going to talk about mortgage interest because that really is boring. So let's talk about SALT. So SALT is the state and local tax limit. So under the previous legislation, the most you could deduct, no matter what it added up to, when you added your property taxes, your state income taxes, and in places like New York City, your local income taxes, you add all three together. If they were more than $10,000, you only got to deduct $10,000. And keep in mind, that's only if you itemize deductions. For a lot of people, particularly if they didn't have a mortgage, this just kicked them out of itemizing entirely. They didn't have enough to be over that 31,500. But now for people who do have more or pay more in taxes in 2025, so this year they raised it to 40,000. They quadrupled it. So now you get to deduct if you're taking itemized deductions, itemize up to 40,000. It creeps up a little bit, but then guess what? In yellow, time limit reverts to 10,000 in 2030. So it goes doink in 1 year. They also put restrictions on it. Income restrictions, which are in blue here. This didn't previously exist. So if your adjusted gross income is over $500,000, you start to lose the 40,000. It'll never be below 10. So 10,000 is the minimum. But if your adjusted gross income is over $500,000, you are not going to be able to deduct all of those tax. It's going to be less. Your cap is going to be less than 40,000 is the best way to put it. All right, so that is SALT. Very controversial, a lot of arm twisting. This is the one topic that almost terminated the bill, that they couldn't get the votes they needed. Next up is, I'm going to skip those, limits on itemized deductions. So these are brand new provisions that take effect in 2026. This is only if you itemize. All right, so if you're taking the standard, this isn't going to impact you. And I know I just lost 80% of my audience because we don't deduct anymore, but hear me out so you can understand what we're talking about. In 2026, they're starting a new policy that essentially says if you are in the top tax bracket, 37%, your deductions are only worth 35. So you still have to pay 2% on your itemized deductions. So deductions are not full value. They kind of put it there rather unsuccinctly, I guess I would put it. It's the 2/37 of the lesser of total itemized deductions or the amount of taxable income. And yeah, that's just jargonese. It's really, we're just taking 2% away from you. Just not, can't deduct it. You're done. They also made adjustments for 2026. Again, this is in purple to charitable deductions. So the first half a percent, again, this is if you're itemizing, the first half a percent of your charitable contributions are not deductible anymore. So, for example, if you're in the top bracket, you take the half percent, you add the 2%, and suddenly you only get to deduct 97.5% of your charitable contributions. But what they did instead is added something that more people are going to take advantage of. Several years ago, they had this little pilot program where you could deduct $600 of charitable deductions. Even if you don't itemize, we'll let you deduct 600 without itemizing. They expanded that and brought it back. So even people who do not itemize can still deduct up to, married filing jointly, $2,000 per year starting in 2026. All right. And that also is indefinite. There's no expiration on that. So again, this would not pertain to qualified charitable distributions. It would pertain to writing checks. You write a check and give it to charity or put it on your credit card, up to $2,000 tax deduction for you without itemizing. Without itemizing. All right, I'm going to skip the AMT because hardly anyone pays the AMT anymore, and it's really confusing, and I don't want to talk about it. Estate and gift tax. So in 2025, if you go to heaven, you have an exemption of up to, let's round that off to $14 million. With proper planning between husband and wife, you can get it up to $28 million that you can pass to the next generation without any estate taxes. The OBBBA increased that 14 to 15 and made it permanent. So, and it will be adjusted for inflation. So the key implication here is that if your estate is over $28 million, you should choose to die next year instead of this year. So make sure you plan accordingly. As far as QBI, qualified business income, so this is tax relief targeted at small businesses. This was created back in 2017 when they cut corporate tax rates for C corps, C corporations. They wanted to be fair to the small businesses. This was set to expire at the end of this year, and they have gone ahead and made it permanent at 20%. And they also expanded a little bit the eligibility for it. I'm not going to go into the details there, but the good news is, excuse me, for small business owners or even those who invest in some small businesses like business development corporations or even some REITs, we have a QBI. All right, so that is that. Let's talk about the things that got the headlines. I haven't reached those right. This is old stuff, and here are the new provisions. Let's get to the new and exciting, the spiffy new shiny objects that were included in the bill. The first one, we had a question on this, so this is getting to that question. For those of you who are age 65 this year, even if you turn 65 during the year, as long as you're 65 by the end of the year, congratulations! Not only did you win an additional $1,500 standard deduction that you can claim, not only do you get to claim the $1,650 additional deduction because you are age 65 or blind, you also get a $6,000 per person tax deduction in 2025. So active this year. Married couples, 12 grand additional tax deduction. Again, this is one of the campaign promises that turned out couldn't be kept. So the promise was, hey, no taxes on Social Security. Using the reconciliation process that they did to pass this bill, no adjustments to Social Security are permitted. So they had to go a different route. This is the route they took, where they're just going to give you a tax deduction. Now, note, this isn't for everybody. right? This has got blue on it. This has got a hoop you have to drive through. Make sure you qualify. So if your adjusted gross income is over 150,000 for joint or 75 for single, you're phased out. You don't get it. Sorry. But everybody under that, there. Now, this also has a yellow, which means it's time sensitive. Keep in mind, this special offer is only available in 2025, 2026, 2027, and 2028. There are no provisions to extend it beyond that. Now, if something is so popular like this, and I think if you ask anyone over age 65, they're probably in favor of this. Why put an expiration date on it if it's so popular? The simple reason is scoring, right? So every bill has to go through the Congressional Budget Office and they have to say it costs this much. When you make things available for a limited time, uh, CBO looks at that and says, well, look, this ends in 2028, so it doesn't cost anything in 2029 or 2030 or 2031. So, yep, zero cost for those years. Again, the games they play is you start these little pilot programs, and then in lo and behold, 2028 comes along and they'll extend it for another 4 years. And that gets scored as 4 years. It's not permanent. So CBO really can't do anything about that, right? It's what the law says. You don't know if they're going to extend it for sure, but you kind of know they're going to extend it for sure. So until CBO starts scoring it as permanent, this is a great way to save money when you are having your bills scored. So it saves money, and the odds of it going away are minimal based on the political clout held by the over 65 crowd. Any questions on that? Throw it to me. I've got one question. I got to find it here. Okay. What is the added standard deduction for 65 or blind? That has been available in the tax code. Wow, I don't even know how long it goes back. More than 26 years. I can tell you that much. If you're over 65, you get a little bump to your standard deduction. So you get the standard deduction, and then you get the little bonus. And now you get the bonus on top of the bonus. So it really pays. For those of you who are dreading turning 65, it really pays to turn 65 at this point. They're practically begging. All right. Thank you for that question. That's our second question of the day. All right. Next up, new car loan interest. So this is kind of interesting. If you bought a car, again, this is retroactive. So some people did this in February and they didn't realize they were going to get a tax deduction. So they're like, yeah, winner. So you can deduct up to $25,000. I'm sorry, $10,000. My mistake. $10,000 of interest on a car loan as long as you meet the government's criteria. Number one, this vehicle has to have at least two wheels. So if you were purchasing a very expensive motorized unicycle, this is not going to work for you. Number two, it has to be final assembly in the US. So you got to put the last lug nut on in Georgia or something. Final assembly has to be in the United States. If it was imported from Japan or Korea or anyplace else or Germany, you're not deducting the interest. And then you can only make so much. So, if your adjusted gross income is over $200,000 or 100,000 filing single, you also are phased out. So you don't get to take full advantage of that $10,000. Again, look at the yellow. Only valid 2025 through 2028. So enjoy that for 4 years. From a financial planning standpoint, we are not recommending going out and purchasing expensive vehicles at high interest costs just to take advantage of this tax deduction, because the math says you still lose. So don't do that. Only do this if you have to pay interest on a depreciating asset, which is generally not recommended. So hopefully none of you will be in the position to take advantage of this. Let's put it that way. All right, next up, no tax on tips. Kind of, maybe, for a little while. What is it? Starts January 1st, 2025. So this year, deduct up to $25,000 for qualified tips. This deduction is available whether you itemize or not. So congratulations for those who work for tips. This is going to be a break for you. The question in the back of my mind is exactly how many people were paying taxes on tips. But maybe that's a something to be addressed later. Um, Things that you have to do. Number one, you have to learn less than $300,000, and the industry you work in has to be accustomed to receiving tips. So the IRS is in the process of putting out a nice list for you. So if you don't know if the industry you work in is accustomed to receiving tips and historically receives tips, they will let you know. I am planning on turning that list into something far more useful. I'm going to put a little brief list in my pocket, in my wallet, and then when they ask for a tip everything today, I'm going to pull it out and I'm going to say, hey, well, are you on the list? And if you're not on the list, you are not accustomed to getting tips, and I would hate to ruin that for you. So I am not going to give you a tip. So that's another useful way to use these new IRS regulations that are coming out. Again, this is only available, limited time offer. Get it while you can through 2025 through 2028. All right, no taxes on overtime. All right, this one's even more confusing. So, good news is retroactive to January 1st again. But it's not all overtime that you get to take a tax deduction on, right? It's not, you don't get to deduct the money you make during, while you don't make those 40 hours. And then once you're in overtime, you're time and a half. Well, you don't get to deduct the time, you only get to deduct the half. So literally, it is no taxes on overtime. So you can deduct up to $25,000. It is available whether you itemize or not. Again, you can't take too much or make too much money over 300,000. If you're getting tips and making over 300,000, that's a heck of a position. And your tips have to be reported on your W-2. If they aren't, then you can't take the deduction, which leads me back to my first question of how many people are, back to the tips question, how many people are actually reporting their tips. This is only available tax years 25 through 28. Um, and again, you're phased out, so be aware of that. All right, the next thing in here is Trump accounts, and I am not going to waste time on them. I think they are, I'm going to say it, they're stupid. They're duplicative. They're someone trying to get their name on something. Not that he puts his name on a lot of things, but just trying to get a name on something. And they're going to be very confusing. And, if you have a kid and you want the $1,000, you can go through the hoops, but I'm not real enthused. All right, so that is what I had, from a impact for this year, impact for next year from a tax standpoint. The other thing you have to remember, I'm just going to stop sharing here. I'm going to move myself out of the way. Stop sharing. The other thing you have to remember is that because this was made retroactive, many of these provisions retroactive to January 1st, 2025, the Internal Revenue Service, which operates on technology straight out of the 80s, maybe the early 90s if we push it, is going to have quite a bit of work to do to go through and publish the regulations to implement some of this tax on tips and no tax on overtime and all that stuff. Great, the legislative language is there. That makes it the law of the land. But the regulations say exactly who gets to claim it, who doesn't, how do you process it, how is it calculated. They have to go through the regulatory process, get those regulations done, including 60-day comment periods. Then they have to go to their computer gurus and go, pull this vacuum tube out and put that vacuum tube in, and get everything reprogrammed so that they can process tax returns correctly. And they are supposed to get this all done by around February 1st. It would not surprise me in the least if we had a delay to the tax filing season. And in a worst case scenario, potentially, we could see an extension from April 15th to something else to give them more time to accurately process tax returns. Plus, you have to think about all the CPAs that need to have their software updated. It could be a train wreck come February or March. If you like filing early, or if you have a FAFSA to do or something like that, you could end up banging your head against the wall for a little bit. All right, that wraps up everything that I had on my list to talk about today. You have not given me. Oop, I got something else here. Hold on, I got another one. I got another one. I got two more. All right. Nope. Is that typical for tax changes to only be planned for the current president and sunset when gone? It is a game that has been played. It's not unusual. Um, it probably had less to do with the president part than the if we extended another year, it costs us X number of dollars. There could be a presidential twist to that because obviously they need to do another tax bill. If they would like to extend it, oh, we gotta do a tax bill. Let's go make some more changes and do some more things. So I wouldn't say it's atypical. Tax changes have also been retroactive before, so that also is not atypical. It just puts a lot of pressure on the IRS to get things done. So thank you for that question. All right. To the best of my knowledge, we have covered everything that you wanted to talk about, and maybe even some things you didn't. We have crossed everything off of my list. We're ready to wrap up. As a reminder, if you want to know our thoughts on a more frequent basis than quarterly power breaks, be sure to read the blogs that we put out on a weekly basis. I write them, or if I'm not in the office, other people will write them. Jacob has been filling in for me occasionally. So look for those. And again, if you have topics for the power break that you'd like to dive into, I was really hesitant about this topic because the last topic was taxes, what could happen, but I felt I left you hanging. So, we wanted to finish up and tell you what did happen. But if you have something else that you would like to talk about in December, send those suggestions my way. I'm happy to talk about what you want to talk about. That's more important to me. With that, I am going to conclude this power break. I hope you had a reasonably good time, and we will see you in December when potentially the snow is flying. So enjoy those 80-degree days this weekend. Take care and God bless. Bye now.